Hello and welcome to Choose FI. Today on the show, we have our good friend Sean Mullaney back for an update episode. So Sean was on in early February on episode 475, which we called How to Access Your Retirement Accounts Before 59 and a half. And this was a really important episode because it went through 7 different options to access money before 59 and a half, which is really something that bedevils most of us in the FI community. Is this possible? Can we do this? Can we actually retire early if we want to? Can we access our money before that mythical 59 and a half? So that was a really important episode. And what's cool about our community is we get feedback, we get questions, and we have somewhere between 5 and 7 questions to go through from you, the community, where we're actually going to add an extra option, which is really cool. And Sean prepared a ton for this episode to really give actionable advice. So with that, welcome to Choose FI. Sean, thank you for coming back. I really appreciate it.
Brad, thanks so much for having me back.
Yeah, this should be fun, man. So this is, I think, the quickest turnaround we've ever had for an update episode. This feels kind of fun here, right? So episode 475, we went through those 7 options. And basically, just to really quickly touch on them, we're not going to spend time on them, but taxable accounts, inherited retirement accounts, the rule of 55, 457Bs, Roth IRA conversion ladder, the 72T, which you blew my mind in that episode about 72T. And now that being a viable option, and also, frankly, just paying the penalty, which might sound abhorrent to people, but when you really dive into it, okay, that's not an altogether unrealistic option. So we gave 7 different options, and I think that episode just really, really resonated with the community. So again, thank you for your time and expertise. And this is a follow-up to that. So yeah, where do you think we should kick off? We got all this feedback, all these questions.
Yeah, some very good correspondence, very insightful questions. There's a gentleman who had a question about 72T, and perhaps he's a little more bullish than I am on the 72T concept.
Nice. Yeah, let's start there. So it looks like that came in from Jeff. And this is a pretty long question, but I'm going to read the whole thing because I think it's important. He said, I've done extensive research on it, 72T, and we are planning to implement one this year. A couple points. First, instead of draining your taxable account before starting a 72T, one might want to keep enough in a brokerage account in order to do some home renovations, replace a vehicle, etc. Also, keeping one past 59 and a half gives tax flexibility by not having to hit your IRA amounts and showing more income than you want for ACA and related purposes. Second, by implementing a 72T now at 52 and not waiting 7 more years to touch those accounts, we are attacking our future RMD tax bomb in much the same way as Roth conversions, but we're able to live off it now rather than in 5 years. Third, my plan is a slowdown plan, and I'll still have some self-employed income, including cattle farming income, which can fluctuate. Sometimes, like this last year, with an easement and resulting damages across our property, we end up with more income than we should have for the ACA and related purposes. By keeping a, quote, non-72T IRA for me, as was discussed, Sean, by you in the show, my wife and I can go ahead and reduce our income by approximately $15,000 between the two of us by still contributing to IRAs, allowing us to reach those goals. We can do this while not changing the 72T annual distribution. So, wow, Sean, there is a whole lot there. And I know you had some thoughts on this.
Yes. So what Jeff is saying is, hey, you know what? Why don't we have taxable accounts and a 72T? Well, first, what often happens with financial planners is folks come to us and it's 2 million, 2.5 million in 401ks and 10,000 in the savings account. And that's it. So in terms of where 72T often comes up, there are some people out there who are not going to be like Jeff. They're just not going to have that ability to use both the taxable account and the 72T. But that said, Jeff raises a very intriguing possibility. And look, I'm not giving advice to him or any specific person, but from an academic perspective, we ought to talk about this. So historically, many advisors have been very bearish on 72Ts. There's risk involved, and you're sort of locking that money up. And I've come along and I'm more bullish on 72T. I'm saying, hey, this actually has some validity and maybe is a bit of a planning tool for some out there. And now Jeff's coming along and saying, no, I'm even more bullish than Sean, right? let me say this. I think what Jeff is saying has a lot of validity. That said, there are some drawbacks. One, the earlier we start a 72T, generally speaking, the worse, right? So that's part of the reason why advisors, myself included, like to drain the taxable accounts first. What we're saying is, look, when you start a 72T, say at 50 instead of 53, it's less flexible, and you have to have a larger 72T IRA to get the same amount of money out. So if we could, we'd rather start at 53 instead of 50, just because the math works out better and the risk profile works out better, right? Because one of the downsides of 72T is there's a risk. The risk is at some point in the 72T term, we're going to screw something up. What that does is it makes those previous distributions subject to the 10% early withdrawal penalty plus interest charges. So we want to avoid that, or we want to at least limit that. And one of the ways we limit that is by starting our 72T later. But that said, what Jeff is saying has validity. And maybe it's, look, if you can build up those taxable accounts so that you at least have an emergency fund and then you start your 72T, maybe that's the way to go. You have to do your own analysis. But I think I think 72T just needs a lot of rethinking among advisors, among end users like Jeff. I'm glad he's clearly doing a lot of good thinking here. But I would just say, I tend to like to start 72Ts later rather than sooner if possible.
Gotcha. Okay, that makes sense. And yeah, just because obviously everybody who's listening to this episode now didn't just listen to 475, though I would advise you to go back and listen to that. But with this 72T, I think the part that blew my mind the first go around was that you can split your IRAs into separate accounts and really target precisely how much you want, I guess, to make subject to this 72T, which is one of the coolest things I've heard in years in personal finance.
Yeah, so Brad, on that, right? So generally speaking, the method that we use, it's called the fixed amortization method, produces an even level payment, right? I use an example on a YouTube video, 80,000 a year. All right, but that's just a level payment for each of 7 years, 6 years, 5 years, whatever the term is. And not everybody has 80,000 of need every year in that one example, right? Maybe inflation increases our expenses, or we're going to go on a vacation one time. So it is possible to increase a 72T and to decrease a 72T. So we can increase it by doing a second 72T. We can't really increase it in most cases, but what we could do is have that, like what I call the non-72T IRA, and then do the slice and dice again. So we have a second 72T IRA and generate an additional payment if we need it. And then the question also becomes, well, wait a minute, I've agreed to get $80,000 of taxable income every year for, say, the next 7 years, whatever the term is. And then maybe in the middle of that term, aunt or uncle dies, leaves you with $200,000 in cash. Well, why do I need to have a 72T anymore? Well, there is a possibility of reducing the existing 72T. It's a one-time switch that's allowed. They call it a change to the required minimum distribution method. I did a YouTube video on that. It gets a little complicated, but essentially, as inflexible as we say 72T is, and it is somewhat inflexible, there are ways to increase those payouts, and there's a way to decrease those payouts if for whatever reason you don't need them as much as you once did.
Yeah, that makes sense. And I think in episode 1, you basically said as a rough guideline, and again, like you stated earlier, this is not financial advice to any one specific person by any means, or really anyone in particular. We're just talking generalities here, right? So I think you said very roughly age 50 is when you could conceivably think about this 72T. Of course, there's no hard and fast, but I think that was your general back of the envelope guideline. I think I'll ask for some clarification on that. But final word from me on 72T is there's a new podcast actually called Forget About Money. And it's by my friend David Boyer, who is actually Stephen Boyer from Camp FI fame, or the creator of Camp FI. It's his twin brother. So his twin brother, David, and actually both Stephen and David interviewed Eric Cooper, who's a friend of mine from the FI community. I actually just saw him at Economy, and it was on 72T and how Eric has gone through this specifically. So this was a 45-minute episode very specifically on 72T. So that was for anybody who wants a little more flavor on that, I think check that out.
Yeah, Brad, I think the math, it'll depend on your case, but 50 is a very rough general guideline where, hey, this is going to make more sense. You got to do your own math on it, or work with an advisor and do your math on that. And thanks so much for mentioning that. I was not aware of that podcast episode, and it's great to hear an end user perspective on something like 72T. So I will go download that episode.
Nice. And yeah, Eric is definitely somebody we could get on the podcast for sure and to really dive into this. So if that's of interest to anyone, definitely let me know, because I think this 72T is something that things just changed in the last couple of years and it's become much more viable. So that's why we're really spending some time talking about it. So, all right, Sean, let's go to question number 2. So this came in from Jessica, and Jessica said, what if you have a decent amount of Roth 401k money in addition to a Roth IRA? How would you leverage this? And in what order would you pull out assets? Example, traditional IRA, pre-tax 401k, Roth IRA, Roth 401k. I mean, John, there's so many of these different accounts. And I think people just need just some kind of mental clarity on how do you even think about it when you have all these different traditional and Roth accounts?
Yeah, great question. So, first, I would, in most cases, recommend a tactical move, which would be to move the Roth 401k through a direct trustee to trustee transfer into a Roth IRA. I am not saying that for investment reasons. I'm saying that purely for tax reasons. It has to do with how distributions from Roth 401ks are taxed versus Roth IRAs. If your plan is, look, I've got this now tax-free Roth, what I refer to as Roth basis, right? Old contributions to a Roth IRA, old contributions to a Roth 401k, and I want to live on that. Now, look, if the Roth IRA is 50 years old and you have tons of that, then maybe you don't need to do what I'm about to say. But what I like to do is before 59 and a half, move that Roth 401k into a Roth IRA. That takes our old Roth 401k contributions, just the employee contributions we made over the years, and it makes those Roth IRA contributions. That's really good because those come out first of a Roth IRA, tax and penalty free at any time for any reason. If it stays in the Roth 401k and we're going to use the Roth 401k to fund pre 59 and a half retirement, the piece that comes out that's attributable to the growth is going to be subject to both ordinary income tax and the 10% early withdrawal penalty. That's a really inefficient way to use a Roth account, right? We want tax free when we do Roth withdrawals, right? So tactically, I think a direct trustee to trustee transfer from the Roth 401k to a Roth IRA is probably going to be advisable. Then the question becomes, well, okay, it sounds like, let's just assume your correspondent here has plenty of Roth basis, old contributions to live between now and 59 and a half. Fine. Then the two considerations become one somewhat optional, which is Roth conversions, because there might be a window to do very efficient Roth conversions from those old traditional retirement accounts. But then two is premium tax credit, right? So many people before 59 and a half, really before 65, may be retired and be on one of these Affordable Care Act health insurance plans. Not everybody, but many, right? And so what they're going to need to do is show a sufficient amount of income to make sure they qualify for a relatively high premium tax credit. If all we're doing is withdrawing Roth basis during the year, old contributions, our tax return starts off at zero. It says, well, you didn't have any income this year. Well, that's perfectly fine unless you need some income to qualify for the premium tax credit. So then the tactic becomes, oh, look at that old traditional IRA or traditional 401k. You know what I'm going to do before year end? I'm going to do some Roth conversions to toggle on enough taxable income so that I get a decent premium tax credit. So that would be sort of the way I would think about it there. Sure, you can live off mostly, if not exclusively, old Roth basis in that example, but you just want to monitor your taxable income. One, to see maybe, hey, we're at zero income, so maybe we just do some Roth conversions just to take advantage of the standard deduction, if nothing else. And then two, hey, maybe we need to do those Roth conversions. It has nothing to do with standard deduction. We just may need to toggle on some income just to make sure we get our premium tax credit this year.
Wow. Okay. There's a lot there. So I definitely want to dive into some of the specifics of this. So let's start right there. So, yeah, for most people, so when you do a Roth conversion, it is a taxable event. So you're actually creating taxable income to go on your tax return. Now, for most normal thinking people, that sounds terrible. But like you're saying, in the FI community, we think a little bit differently. We think a little bit smarter. So, if you have no other income, you might have a piece that you get the standard deduction anyway. So it could wipe whatever income you create down to zero. So you're in essence saying, hey, tax me on this. but I get this standard deduction, wipes it down to zero. My tax liability is zero. So that's one possibility. The other is there's this interesting balancing act, right, between taxable income, tax liability, but also the ACA subsidies. So this is something I know my brother is grappling with right now, actually, because they currently have no earned income, but they ultimately, I guess, really the reason, as far as I understand, and I love your clarification, Sean, is if your income is zero or too low, you are not getting those amazing ACA subsidies. You're actually, in most cases, being put on Medicaid or some type of similar program. And that's something that many people, for whatever reasons, want to avoid. So it's this, okay, I want my income low enough to get the significant ACA subsidies where I'm paying close to zero or minimal, but I don't want my income to be zero because it will kick me into another program that I might not want to be on. Are we understanding that correctly?
Well, yeah. So, and I will say I'm not a Medicaid expert, far from it, but my understanding is the premium tax credit eligibility is based on Medicaid income eligibility. So they say, okay, are you eligible for Medicaid based on income, not eligible in a general sense,
Right.
just if we're only looking at the income test. And so if your income is below, and you have to actually pull your state, it varies state to state. My understanding, I think it's something like 100% of household federal poverty level in some states, 138% in other states, I think 150 in some states. So you got to look at your state, state by state. So yeah, we want to make sure our modified adjusted gross income, which is for most Americans, it's going to be your income before the standard deduction, right? Not everybody, right? So don't add us on that point. But for many Americans, it's simply just, okay, add up my income before my standard or itemized deductions. And you just got to make sure it's above that minimal threshold just to make sure, okay, based on income alone, I don't qualify for Medicaid. So great, now I qualify for a premium tax credit. So I've turned on the premium tax credit by this relatively modest amount of income. But yeah, if everything's in a retirement account, you're under 59 and a half, you have no earned income, you're basically going to start the tax return at zero, which from an ACA perspective is not a good place to start. But fine, then just do some Roth conversions and you can get there.
Yeah, and this speaks to just having flexibility. So on the face of it, it sounds wonderful. Like let's Roth conversion as much as we can to pay zero tax, understanding that we could pay zero tax in that situation, but it's not always the most advantageous thing.
Well, and Brad, so, this episode's for those generally in their 50s, right? But really, this is for accumulators, this conversation. It's not real. I mean, yes, it is for people in their 50s because I was listening to a popular podcast. I won't name names, but I was listening to a popular podcast prior to recording today. And there was a very well known gentleman on there saying, oh, young people, especially, it's all got to be Roth. And I'm listening to that, and
No.
the smoke is starting to come out of my ears. I'm like, what are we talking about? Right? You are if everything's in a Roth going into early retirement, you are setting yourself up for failure. How are you going to generate that money if everything's in a Roth? I'm not saying never do a Roth. In fact, I'm a big fan of the Roth IRA at home, but at work, I'm a big fan of the traditional 401k. And this is part of the reason is we want to have that ability to at least toggle on some income prior to age 65.
Yeah, you've actually convinced me to become more of a fan of Roth, to be honest. And I think part of that is because of the contributions that you can pull those out at any time, tax and penalty free. So that was like an interesting note from a couple episodes ago that you've been on that has stuck in my mind. But I think, and I do want to touch back on the Roth 401k, which was the ultimate question from Jessica. But just kind of last word on this is that, yeah, I mean, for me, as part of the financial independence community, it's always been okay, let's really try to max out our traditional accounts, the traditional IRAs, the regular 401ks, because it's, as we've always said, it's control what you can control. And if you can get the tax deduction now, lock that in as a guarantee. Of course, every situation is different. I can't know precisely what your marginal tax rate is, yada, yada, yada. But that said, if you can lock in the tax deduction now, then there is a reasonable chance with a lot of these advanced FI strategies, like the Roth IRA conversion ladder, and truly understanding this kind of free money concept of are you able to earn income and still, in essence, wipe it out with the standard deduction? There's a real chance you might never pay tax on that, or certainly a significant portion of it, right? I mean, Sean, you're nodding like crazy. Like that is the key. And that's why I would say, no, dump everything in Roth IRAs. They're wonderful. They're great. We're not saying otherwise, but goodness, there's a lot of benefit of the traditional and controlling what you can control today.
Brad, you've alluded to a phenomenon I refer to as a hidden Roth IRA, right? They're going to be retirees who, prior to signing up for Social Security, are going to take money out of the traditional retirement account, traditional 401k, traditional IRA, doesn't matter what it is, traditional retirement account. It's going to go on their tax return and it's going to be taxed against the standard deduction. It's going to have a 0% income tax. Oh, wait a minute, a tax free withdrawal from a retirement account? I know what that is. That's a Roth IRA. I refer to that as the hidden Roth IRA that lurks inside your traditional 401k or traditional IRA. Nobody's talking about this, right? So when there are commentators out there, right, because you're going to, go in your podcast player and listen to another podcast, and they're going to say, everything's got to be Roth, everything's got to be Roth. Well, wait a minute. When you do your traditional 401k at work, like Brad just mentioned, you are setting up a potential hidden Roth IRA. And oh, by the way, you're getting an upfront tax deduction for doing so. I think that's pretty good planning.
Yeah. Yeah. It's better than a regular Roth IRA or Roth 401k in that sense, right? Because you got the tax deduction up front. You didn't pay tax on it. So, anyway, I think we've covered that. It's so important that people just think about this. But let's just touch really quickly on Jessica's kind of main question, which goes back to the Roth 401k. So, some clarification. Basically, you were talking about, okay, let's roll, and hopefully that's the precise terminology, but roll a Roth 401k into a Roth IRA. Now, what you said specifically, and we've talked about numerous times, and just a couple of minutes ago, was contributions to a Roth IRA contributions can be pulled out tax and penalty free at any point. Now, what it sounded like was if you pull money out, if you get a distribution from a Roth 401k, that it doesn't work on those same ordering rules, if you will. That in order to do that, it has to be the character then has to be a Roth IRA. So I guess A, confirm that, and B, let us know how would you document what was originally contribution to that Roth 401k that's now going to be sitting in the Roth IRA. Is there a process for that?
Great question, Brad. So this has to do with, you would think like, oh, it's a Roth account. So the distribution rules before age 59 and a half are the same. And I'm here to tell you they're totally different, right? So when we have a Roth IRA, it's great. It's what I refer to as layers. And one layer has to be fully removed before we get to the next layer. So the first layer that always comes out of a Roth IRA is our old contributions, our annual contributions. And that's the best layer, by the way. So the distribution rules are taxpayer favorable because the old contributions come out at any time for any reason, tax and penalty free. We really like that, right? Especially if we're before 59 and a half when we just retired. That's a really good rule. Well, what about a Roth 401k? What are you talking about? Well, that's subject to what Ed Slott refers to as the cream and the coffee rule. So what that's saying is anytime you take a penny out of the Roth 401k before age 59 and a half, you have to look at it and you have to say, well, what's inside that Roth 401k? And you allocate that penny, that dollar, that $100 between the two things pro rata. So it's the old contributions and then just the earnings, the growth, right? So say over the years you contributed $100,000 as employee contributions to your Roth 401k. Great. It's now grown to say $200,000. You take a dollar out of that Roth 401k before you turn 59 and a half and you've had it for 5 years, 50 cents of the dollar will be a tax-free, penalty-free return of contributions, fine. And then 50 cents of that will be a return of your earnings, which are subject to both income tax and the 10% early withdrawal penalty, right? So that's no fun. So the workaround there is, all right, let's separate from service and then do a direct trustee to trustee transfer of the Roth 401k to the Roth IRA. And when we do that, the record keeper should have a record of your old contributions. I'm not here to say that every record keeper will have that. In theory, that's on all your W-2s. I think it's box 12. Is it 12A and it's code AA, something like that? There is a listing on your old W-2s. I mean, in theory, your payroll records would have this too. But in theory, I know at least one Roth 401k custodian I'm familiar with just lists like your overtime historic contributions. So you have that. That number is important because that goes into your Roth IRA as old contributions. The rest of it goes in as earnings. But in my example, 100,000 of contributions just go in as now Roth IRA annual contributions. We can now take out that 100,000 and it comes out first along with the other annual contributions the Roth IRA may already have. Yeah, so it's an odd situation where Roth 401ks are taxed different than Roth IRAs. But what it means is the Roth IRA can be the lifeboat to get our Roth 401k more accessible to us prior to age 59 and a half.
Yeah, that makes a ton of sense. I guess let's say you did not have a Roth IRA. Can you just set up a shell of a Roth IRA and do that still?
100% you're allowed to do so. And remember, people get hung up on these 5-year rules. They have nothing to do with Roth IRA annual contributions.
Yep. That was my next
So
question, Sean.
if you have a Roth 401k, you never had a Roth IRA, you can set up hey, XYZ brokerage, please set up a new Roth IRA. I'm going to do a direct trustee to trustee transfer into you guys, $200,000 Roth 401k. It goes into the new Roth IRA. That thing can be, 2 weeks old. You take your first $10,000 distribution. Well, it's just a return of annual contributions in that case. Now you're down to 90,000 of previous annual contributions after that. But yeah, you've got some runway to live some life before 59 and a half just through that direct trustee to trustee transfer I talked about.
Yeah, that is fantastic. And I think the only other thing that you snuck in there that was slightly technical was you said something about separating from service in order to do that. So you wouldn't be able to do this if you were still employed, I guess, depending on the rules of the Roth 401k, right?
Yeah, that's a great question. Generally speaking, it's going to be the rules of the plan. Some plans may allow in-service distributions, from the Roth 401k to a Roth IRA. But in most cases, especially if we were looking to get all of it out and live off it, generally speaking, under the plan rules, look at your plan. But generally speaking, we're going to have to separate from service to make that an easy process. But there are some plans that allow in-service withdrawals. That can be more of a plan rule than a tax rule issue.
Yeah. Awesome. Very, very helpful. All right. Let's move on to the next question. So this came in from Chris, and he said, I don't hear much talk about specifically the Roth IRA conversion ladder and the mechanics involved. Because I think a lot of the community may be retiring early, they, like I, would like to know more. I'm curious about the pro rata rule and want to know if I only transfer the portion I want to convert to my traditional, then Roth IRA, or while this may be determined by the employer plan. I think there could be a lot to consider and want to make sure I'm planning correctly for our future.
Yeah, there's a lot there. I'll start with the pro rata rule because a lot of folks in the community get hung up on the pro rata rule. And here's the thing, from a tax law perspective, tax rule perspective, it's something that governs distributions from traditional IRAs, SEP IRAs, simple IRAs. From a practical perspective, it hangs us up, it hurts us in the accumulation phase. It doesn't really hurt us in the decumulation phase. That's counterintuitive, but there's a lot of counterintuitive stuff in tax. So what do I mean by that? The problem with the pro rata rule is the ability to efficiently do a so-called backdoor Roth IRA, right? We're trying to get money into a Roth IRA during our accumulation years. This is where the problem emerges. Well, what happens is, we're trying to do this backdoor Roth, but the tax rules say if we have another IRA, like a rollover from an old 401k, then we can't really do the backdoor Roth without incurring additional income tax. And in that case, then it doesn't make a whole lot of sense. So if we're thinking about retirement, we don't have to be all that worried about the pro rata rule with one exception. And it's this: when we leave our job, we should look at our 401k, 401a, 403b, whatever it is. And we have to ask one question: is there basis inside our retirement plan at work? For most Americans, the answer will be absolutely not. But there are going to be some people where the answer is absolutely yes. This happens for a variety of reasons. Now, the basis emerges if we're doing the so-called mega backdoor Roth, but then it goes right away. So we don't have to worry about it if we've been always just doing the mega backdoor Roth and that's all we've done. But there are going to be some people out there who can't do a mega backdoor Roth and have this old retirement account basis in their 401k or other plan. If that's true, then you want to be worried about the pro rata rule. There's an easy way around it. You take that basis only and you move it to a Roth IRA at retirement. The rest of it would go to a traditional IRA. There's something, if you Google Notice 2014-54, there'll be all sorts of commentary on the internet about this. Because the alternative to what I just described, moving basis into a Roth IRA and then the rest of it into the traditional IRA is just moving all of it into a traditional IRA. You don't want to do that, and you don't have to, according to this IRS notice, right? There's a notice from the IRS saying, yeah, take the basis, put it into a Roth IRA, take everything but the basis, put it into a traditional IRA, and now we're outside the pro rata rule. That's really cool, right? So that's the one time at retirement we want to be worried about the pro rata rule. Okay. What about Roth conversions in retirement? People get hung up on this, but it's actually pretty easy. And I would say for most Americans, the easiest mechanism is the traditional IRA, but there are going to be some 401k plans that allow this too. Easiest mechanism is go into your financial institution with your traditional IRA, say, hey, I want to take $10,000, $5,000, $20,000, whatever the amount is in your particular situation, and I want to affirmatively move it to a Roth IRA. Okay, that's fine. There'll be a big warning sign. This is taxable. You're like, yes, that's my plan, right? That's the goal.
Doing that
All
on
right.
purpose here.
Yeah. Now they'll also ask about, they may ask about tax withholding. I generally don't like to do tax withholding. There are other ways to pay that tax. If there's going to be that much tax, there may not even be that much tax. And we just affirmatively move the money from the traditional IRA to the Roth IRA. And one of the things about that is that can set up something called a Roth conversion ladder, right? So 5 years later, under the tax rules, we can access that money again, penalty free and tax free. That's something we might want to do. We may not even want to do that. We might be living off taxable accounts at that point. We may have other Roth basis, right? We may have older conversions, older contributions. So we may not have to worry about that 5-year rule for that conversion anyway, but maybe that's part of our strategy. And the mechanics of the Roth IRA conversion tend not to be that complicated. I like to do them later in the year. There's an academic argument to do them in January and February to get the additional months of tax-free growth. I just like to say life is at least somewhat uncertain, and Roth conversions are not reversible under today's rules. So I'd rather wait till October, November, do my little spreadsheet, right? 5 people tend to be good with spreadsheets, right? But do my little spreadsheet, basically mock up a mini tax return. What's my interest income this year? Dividends, capital gains, part-time income, Social Security, rental income, whatever it might be. Just mock that up and do estimates for November and December and say, okay, where am I? Where am I against maybe the 12% tax bracket? That's a good guardrail, maybe not the right guardrail for everybody. What does this do to my premium tax credit? And October, November, do a Roth conversion based on that knowledge and manage for tax rate and manage for premium tax credit.
Yeah, that is brilliant advice because you would have just simply more insight into your taxable income position in the latter stages of the year, right? So that's just a cool little tip that I think honestly most people would not have considered. So yeah, Sean, I like that. And yeah, I think Chris's ultimate question speaks to this sounds daunting. I think that's why it's this term, right? The Roth IRA conversion ladder. It sounds terribly daunting, but in essence, it's exactly what you just said. These brokerage firms, they are used to this. This is a fairly standard thing. There's nothing crazy that has to go on. Like you said very specifically, they are going to give you alert after alert. This is a taxable event. They're going to be taxed on this. Do you want to withhold tax? Okay, we understand it's a taxable event. We're doing that with eyes wide open. We're doing that very overtly and specifically. Like you said, obviously we can't give financial advice. In most cases, you're probably not going to want to withhold on this. If you're doing it anyway, and very specifically, there's probably a reason for it. You're probably paying a very low marginal or effective tax rate on that conversion. So you obviously have to do whatever works for you, but I think it should be pretty simple. But I guess, Sean, actually just kind of like a very precise question about how this mechanically is done. So you're taking, let's say, funds from your traditional IRA and you are converting it into a Roth IRA. Now, I guess if it was just cash sitting in your traditional IRA, super easy, it just gets moved over. What if it's invested in a mutual fund or ETF or something? Does those shares get moved over? Or do you sell a certain portion? Am I just not thinking about this right? How would that work mechanically?
Yeah. So my understanding is you wouldn't have to do like this independent sale and turn it into cash, right? You would log into your traditional IRA and see, I have ABC bond fund, DEF stock fund. You would say, I want to do a conversion of, however many shares or dollar amount of each, or one or both, right? 20,000 of ABC goes into my Roth IRA. And then you invest in something in the Roth IRA. Maybe the Roth IRA has GIH, GHI or whatever fund. You pick the fund, or maybe it's the exact same fund, right? ABC bond fund into ABC bond fund, ABC bond fund into DEF equity fund. I'm not aware that you would have to do a separate, that you can only move cash from one to the other. And by the way, my guess is, look, I've never worked for a brokerage, but my guess is what they may do is they may just sell inside the traditional IRA, generate the cash, move the cash to the Roth IRA, and then immediately reinvest it, right? I can't say what the brokerages do on their end, but I'm not aware that there's any sort of requirement that you separately say, oh, I want to do a $20,000 Roth conversion, so now I need to sell 20,000 of cash inside of my IRA to then do that. I'm not
Cool.
aware that that's a requirement. I mean, check with your brokerage, but it should be a relatively easy portal. And there, like you said, Brad, this happens all the time. This is the flavor of the day.
Yeah.
People talk about Roth conversions all the time. So the brokerages are very used to a traditional IRA conversion to a Roth IRA. So I don't think this should be at all daunting. It's just playing on a website.
Yep, wholeheartedly agreed. And if you can't figure it out on the website, just call the 800 number for support. In my experience, they're all pretty helpful. I've called Fidelity, Schwab, and Vanguard at separate times, and I've never had any problems. So, all right, that was wonderful. Let's move on to the next question. Okay, so Sean, this one came in from Kristen. And Kristen actually came up with maybe an option that we didn't consider in the first episode. So she said, I just listened to the latest episode with Sean. Great show. But I'm thinking there's one more option that he didn't mention: withdrawal from HSA for medical expenses, for current expenses or for reimbursement of past medical expenses. And she was hoping that we could address it in the next mailbag or update episode. So what do you think about HSA as maybe the 8th option on the list?
Yeah, Kristen raises a very intriguing possibility. So I have a technical term that I made up for this concept. It's called, it sounds like an expletive, but it's not. It's called PUQME. Previously, no, but Brad, it's previously unreimbursed qualified medical expenses.
Yeah.
PUQME, right? And
it's
so what this is this is sort of your register of, all right, I opened an HSA on day one, whatever that was, January 1st, 2015. Since then, I've had all these medical expenses, weekend warrior injuries, doctor's appointments, whatever it is. And I've kept my little spreadsheet on them. I just paid them out of my, checking account, my credit card, never took money out of my HSA. So now, hey, I'm retired in my 50s. I could take a reimbursement of PUQME, and that's tax and penalty free. I think Kristen's raising a very intriguing possibility, one that I think might be more of a complementary player in this rather than a primary player. So what I mean by that is you're limited in your 50s to the lesser of your HSA account balance or your PUQME balance, right? So if you haven't had that many previously unreimbursed qualified medical expenses, there wouldn't be much runway to take this in your 50s. Or if your HSA just isn't that big, which it may not be, the contribution limits are still somewhat modest. So it's going to be like a modest supporting player in a early to mid 50s drawdown strategy. The other sort of drawback to that tactic is we generally like to let HSAs bake tax-free for years, if not decades, rather than taking the money out in our 50s. But that said, I think Kristen has identified a very valid supporting player in our pre-59 and a half drawdown tactic toolbox.
Yeah, I love it. That's why this is the ultimate crowdsourced personal finance show, right? Like you said, it's a supporting option, but it's a really viable one. So very, very cool. Just while I have you on this, Sean, talking about HSAs. So a lot of people, we don't overtly talk about HSAs all that often. And I know on multiple past episodes, I've talked about maybe how I keep my medical invoices. So basically, I have, like you said, I have spreadsheets of so by year is how I keep it. So I have one spreadsheet by year for medical expenses paid out of pocket. And then the invoices that I get, I use a scanning app on my phone. I think it's called Genius Scan. And I just very simply save a PDF of every invoice and just save it to a folder on either Google Drive or Dropbox. And I feel like the combination of those two is good enough in this instance. But I guess one question for you, and I don't know if you have the answer because this is like really in the weeds, but what I'm saving is the actual invoice from the doctor or hospital. it's not a proof or record of the actual payment made, because in many cases you don't get that. And I have this lingering fear in the back of my mind that I'm going through all this effort to make the payment, obviously keep the record of it in the spreadsheet, keep a PDF invoice, but I'm saving the wrong thing. Has this ever crossed your plate? Like, is there truly a way to document and to do it right?
Yeah. So that's a great question, Brad. So, what you need to be able to prove is if the IRS audited you and you took, like, you're 66 years old, Brad Barrett, you took $7,000 out of your HSA for the year and you claimed it was a reimbursement of previously unreimbursed qualified medical expenses.
PUQME.
Yeah, of PUQME. So, what the IRS would have to do to overturn that and make that a taxable distribution is they would need to prove you didn't have 7,000 of previously unreimbursed qualified medical expenses. But you got to remember, let's say you did that let's say you had a surgery and you said that was exactly $7,000. And for whatever reason, the IRS was like, no, you don't have sufficient documentation for that 7,000. Yeah, but you might have sufficient documentation for 27,000 of other medical expenses. So, from a strategic perspective, if I'm the IRS, this is going to be a difficult tree to bark up because I could win on Brad's specific assertion and still lose the matter, right? Because, well, it doesn't matter. Brad can't prove that $7,000 surgery, but Brad could prove 27,000 of other expenses. What are we doing here from an IRS perspective? That said, we don't have to have videotape evidence of you going on your credit card and, paying the bill and all this sort of stuff. You have to have reasonable evidence to prove it to, first level would be to a revenue agent. And then the second level would be, to a court if you ever audited or, this ever became a dispute. And the level of evidence does not need to be, I've got bank wire transfer, I've got the receipt, I've got my own spreadsheet, right? You would think that some reasonable combination of evidences would be enough. Look, that's going to be up to the judge. Depends on the courtroom, depends on your testimony, right? So I don't want to give litigation advice in this, but I think you just want to think about it from a strategic perspective. And I would not be losing sleep if I didn't have I have the invoice and I have my own spreadsheet, right? Those are two compelling pieces of evidence. I'd feel pretty good about that, right? So it just sort of depends on the facts of the case. But why the heck did somebody give you an invoice if you never paid it, right? Wouldn't there be some sort of trail of them barking up? Well, there's no trail of them doing debt collection on you. So you probably did pay it, right? Or the insurance paid it. But then, if the insurance paid it, it doesn't qualify as PUQME, but that's a whole other conversation. If they were billing you, it probably says, this is the amount the insurance already paid. Now here's the 7,000 we want from Brad. Anyway, so
Cool.
Sorry, a bit of a long answer. It's not entirely clear, but I also don't lose a lot of sleep on this issue as long as we've got some very valid evidence.
Yeah. So it's ultimately a thinking in bets type of scenario, which is in this case, the likelihood of you getting audited, period, is very, very low. And then you have, in my case, I have very legitimate evidence in two separate cases. And I will have a trail of probably 40 years worth of very precise invoices. And like you said, okay, are they really going to go to bat over X amount of withdrawal? Because again, in this case, I'll have 40 years worth of backup for it. Almost invariably, I'm going to have enough legitimate invoices, et cetera, maybe in their eyes, even though these are all legitimate, to cover this. So the likelihood of this being a problem is almost zero. So anyway, that was kind of selfish on my part, but I think it's a larger question of, okay, how do you actually document these things? And I think your answer, if I can summarize, is you do the best you can, right? And in this case, okay, very clearly, you paid a bill out of pocket. Just document it. It would be really easy just to have a running spreadsheet and to save something to, print. If you have a print, you get something in email, print it and save to PDF, right? Super easy.
Yeah. One, we're not telling people, well, don't worry about it because the IRS won't audit you. That's not what we're saying at all,
obviously
right?
not. Obviously not. These are legitimate. Let's be clear.
Yep.
Like this is as clear as day, Sean. I'm sorry to talk over you. In my case, these are very, very legit. I mean, I have this tied to the penny, obviously.
Yep. Yeah, I would say, one thing you can do is in that spreadsheet, make a note of how you paid it. right? Whether it was the credit card, whether it was a check, which credit card, right? It was on my, Bonvoy, Hilton, Marriott, Hyatt, Delta Airlines, cashback, whatever credit card or whatever. Just, you're increasing the evidence in your
Yeah.
favor if you just make that little note, right? And then in theory, now 20 years later, you're probably not going to be able to pull that credit card receipt. So maybe you still want to save the credit card. But if you had an invoice and you had a spreadsheet like that, boy, that seems pretty good to
Yep.
me. I'm not the judge, right? So, get me a judicial appointment and maybe we'll, but anyway, so
Yeah.
there you
Okay.
go.
That's awesome. I think we've covered it. And I do precisely that. I write on the thing, credit card payment made, the exact date and the exact amount. And if they give me some type of confirmation code or some such. So just to add to the flavor of it. So, all right. I think we're good there. Let's move on. This is a question from Shelly. Can I take withdrawals out of my traditional IRA or 401k to pay for college education while I'm still working? I've tried internet searches, but I can't tell if the 10% withdrawal penalty applies. What about the Roth IRA or Roth 401k? Can I take out the gains along with the contributions for education? And how do I deal with this on my tax forms ultimately?
All right. So several things going on in this question, Shelly. So first of all, if it's a workplace account, whether or not you can take that money is going to be up to the plan documents, right? So that's a plan rule, not a tax rule. You have to look to your 401k. Could you take a distribution from your 401k, traditional or Roth, to fund college tuition, right? That's up to your employer's plan. That's not up to Brad and Sean, unfortunately. All right, but let's think about using retirement accounts for distributions for funding higher education. Now, there's actually, Brad, I'm going to send you this IRS URL. There's a website where they have all these penalty exceptions. And one of the penalty exceptions applies to IRA withdrawals, but it does not apply to workplace plan, 401k type withdrawals. It's for higher education. So, what in theory Shelly could do is if she had a traditional IRA, she could take a distribution from it and use that to pay a child's, say, college tuition, maybe her own college tuition, right? You have to just double check the rules on that, but she should be able to take that, pay her child's college tuition. If from a traditional IRA, it's taxable, but it won't be subject to the penalty. And then she's referring to the tax return reporting, which gets really confusing. So what's going to happen is this: Vanguard, Fidelity, Schwab, E-Trade, whatever it is going to issue Shelly a 1099-R for the year and say, hey, Shelly, you took out $15,000 from this traditional IRA. And oh, by the way, it's all taxable, or the taxable amount's not determined, or whatever it's going to say. That financial institution has no idea what you did with the money. They don't know if you went to Vegas, if you paid for a heart transplant, paid a college tuition bill. They have no idea. So they just say, you took this money out. All right, now put this on your tax return. Well, guess what? You're going to have to put it on your tax return. If it's traditional IRA, it's fully taxable. But then you also attach to your tax return a form 5329. And there's a code on this. What you have to do is you have to say, well, I took this money. I'm not 59 and a half, but don't charge me that 10% early withdrawal penalty. I took the $15,000 out. The code is 08. You put the 08 code, go to the instructions to the 5329. There's a code that tells the tax return software, okay, no problem, no early withdrawal penalty. Still income taxable, but fine. But Shelly also raises the possibility maybe I use a Roth IRA for college tuition before 59 and a half. That's a valid move too. All right. And assuming it's a return of old annual contributions, tax-free as well. The problem with that is that creates income from a FAFSA perspective. So this is, people don't talk about this too much, but, we love Roth IRAs. Who doesn't love tax-free growth, right? But there's this sort of hiccup. If we take a withdrawal from a Roth IRA during the years that are FAFSA relevant, and what we're doing is we're saying, okay, FAFSA people, whoever determines expected family contribution, we have additional income. You say, wait a minute, that was a return of my old annual contributions. That's not income. Not according to the FAFSA people, right? Their rules say a retirement account distribution, whether it's traditional or Roth, is income. So we may now have a higher expected family contribution to tuition, i.e., we're going to pay more to the college because we had this additional income that FAFSA says is income, but we don't think of as income. So that's sort of an interesting issue. My research on this on the HSA indicates the HSA PUQME distribution would not be subject to this pitfall. So, interesting enough, there's a little advantage to HSA PUQME over Roth basis in this particular case. So, Brad, I hope that answers the question. I'm happy to talk further about that.
No, I think it does. And yeah, it's amazing how, like you said, there are always these interplays between the different things. We've talked before at length about the ACA and having enough income, having a low enough income to get subsidies, but to qualify. And now, like you're saying, she's asking very specifically about education. So you have to think FAFSA. And it's fascinating that that really does come into play. So just like always with this stuff, it's just the more you know. And that's just another piece of information that we all have to file away, which is, like you said, retirement account withdrawals, create FAFSA income. Hard stop. It's just something we need to know. So, yeah, very, very helpful, Sean. All right. The next one came in from Matt. And Matt said, how does the rule of 55 work with solo 401ks? Can you retire pre 55, work a side gig, and open a solo 401k at age 55, roll funds into that account, separate from service, and then withdraw penalty free? So I like Matt's thinking here. It's certainly outside the box. But Sean, is this viable?
All right. So, really interesting question. And I think Matt is touching upon a somewhat uncertain area of the tax rules. So, to my knowledge, the IRS has never issued any definitive guidance on this particular issue. So, there's two things that are in play. One is this: in order to use this rule of 55, which we talked about last time, you have to quote unquote separate from service, right? That means you have to leave the job. And in Matt's case, that job would be self-employment, right? You could separate from self-employment. You just don't do any more self-employment. But then there's a second rule we're running up against, and it's this: a solo 401k needs an employer to sponsor it in order for it to exist. If I'm self-employed, I have Schedule C income, and then I retire from that, aren't I no longer self-employed, meaning I'm no longer an employer, meaning I can no longer sponsor a solo 401k? So, I can't say I've thought about all the permutations and combinations here, and I'm not here to give anyone a definitive answer. But my initial, analysis here would be I would be very hesitant to rely on the rule of 55 in the solo 401k context, because that means I've separated from service, which means I'm no longer an employer, which probably means I can no longer sponsor the solo 401k, at which point the solo 401k would need to be direct trustee to trustee transferred, preferably into a traditional IRA. Or if you go to a W-2 and they've got a 401k, you could move it over there. So Matt's touching upon a really interesting issue. I can't say there's a 100% definitive answer here, but my analysis is it's probably not available in the solo 401k context.
Okay. Yeah, that certainly makes sense, the logic of it. I guess a more general question, and this I feel like is something I should probably know, but it's just so specific, is I guess to Matt's larger question, forget the solo 401k, but he's talking about rolling funds into account. So in order to kickstart this rule of 55, now, can you roll an old 401k into your current 401k? Let's say, forget this solo again, forget that this is a side gig, just you're working a job, and then have it all subject to the rule of 55? Is that something, does it depend on the rules of the plan? Is that something that's viable, or am I just totally off base here, Sean?
I think it's totally viable. I would double check the plan. I've never actually come up against that scenario. So theoretically, it should be fine. I would just double check the rules of the plan, though, to make sure that that money can easily come out. After the year the year you turn 55 or later, you separate from service. You just, before you rely on the rule of 55, regardless, you just want to make sure, okay, I separate from service. I'm 56 years old. How easy is it for me to get partial periodic payments, regardless of what you were talking about? Maybe I've been there 30 years. I just want to make sure that this is an easy, under the plan contours, it's easy for me to go in March and grab $7,000. And then in May, it's easy to get $8,000. And then in June, $3,000, July, $8,000, whatever it is. I just want to make sure that that is going to be easily done. And plans have a wide latitude in terms of how their distributions, particularly before 59 and a half, work. So that's one of those diligence points. If we're relying on the rule of 55, we just want to go in and do our diligence in terms of our specific plan. But conceptually, what you're saying, it absolutely seems possible.
Okay, cool. Very cool. And yeah, I think the upshot of all of this is check with your plan. Go to the
Yes.
HR department. If they don't know, go the brokerage that helps facilitate the plan can help. So just ask these questions. Every plan is different. And I think that's something we've seen as a through line on both of these episodes. So all right, next question, Sean, came in from Kiva. And the question was, Sean said the tax code wants us to be early retired and married. I see what he means with the early retired part, but I don't see what the additional benefit of being married is, though. The numbers, for example, deductions brackets for single filers are generally just doubled for married filers, right? I did notice that you circled back and confirmed the early retired part, but not the married part. So I still wanted to check in for clarification. So, yeah, great question. Would love to hear your thoughts on this.
Yeah, this is a great question. And so I've got three different areas I look to. The first area is this year's tax return. Husband and wife, they're both accumulators. Does the tax code want us to be married or single? In most cases, the tax code probably wants us to be married, but that to my mind is sort of nickel dime. I don't really worry about this year's tax return too much from a planning perspective. I'm a lot more interested in the future and especially the long term future. And that brings us to 2 points. One is early retired and married tends to be the sweet spot, right? So I think this is where the married folks have a real advantage. And it's a confluence of sort of two things. The correspondent is absolutely right that all they do for the standard deduction and for those low tax brackets is they just sort of double them. So we think, oh, okay, so singles are about the same as marrieds. But we have the confluence of two different things that sort of say, no, marrieds are actually much advantaged in early retirement. One is this: a married FI couple tends not to spend 2 times what a single FI person spends. Right now, this varies. For food, it's probably about 2x, right? But for hotel stays, it's not 2x. For airfare, yeah, it is 2x. For housing, it's probably not 2x. So it varies, but it generally doesn't get to double what our single person spends. And that then affects their tax return because they don't have to take out as much money. They're not creating as much taxable income as double a single person. The second thing is when we have two people married, one of them earned less and generated less in terms of retirement accounts, taxable accounts. And so when we put all that together, the less spending and the fact that one of them didn't build up as much in terms of retirement accounts, taxable accounts, when we do our initial analysis, maybe we get, before tax planning, we get a single person with say 15,000 of adjusted gross income. What's the married couple going to look like? In most cases, they're not going to look like 30,000. They're going to look like 20,000 or 25,000. Well, once you start with that premise, our Roth conversion runway is going to be so much more every year, and this will compound. Our Roth conversion runway is going to be more for our married couple. So that's the first big reason. Is it just turns out that Roth conversion runway tends to be more than 2x for a married couple than a single person, just because of these phenomena of we don't have 2x the spend, we don't have 2x the wealth, generally speaking, when we're married. Okay, so that's one thing. And then the second thing is treatment at death. This is so important. The tax code wants you to leave your assets to your spouse. And I'll give you one example, is the HSA. Oh my goodness, right? I die, I leave my HSA to my spouse. It becomes her HSA. It's totally tax and penalty free to her. And now she can use it as an HSA for the rest of her life. Fantastic. What if I die and I'm single and I leave my HSA to my mom, my dad, one of my brothers? It is fully taxable to them in the year of my death and it loses its HSA status. Terrible. Well, okay, HSAs, that's a small piece of the pie, yes. Well, what about traditional IRAs, Roth IRAs? The tax rules very much favor married people. Generally speaking, the married person can make that traditional IRA, their Roth IRA, their own, delay distributions, or if it's Roth, they don't ever have to take distributions. Versus if I'm single and I leave that Roth IRA, traditional IRA to my sibling, my parent, they will have some tax planning, some ability to mitigate the hit, but it's nowhere near as good as my spouse does. So for the early retirement planning and for the death, the transfer of assets, particularly tax advantage assets, death, I very much think the tax code wants us married, whether we like it or not. It's just the way the rules are written.
Yeah, Sean, thank you for the flavor on that. And Kiva's question, on the face of it, it's, hey, I don't really understand why, because it is just doubled, right? The brackets are doubled. The standard deduction is doubled. It seems like it shouldn't favor, but yeah, you just gave a lot of flavor there that I think is really helpful. And again, this is a sense, it's an argument, right? In terms of, okay, look, here are the reasons why. And obviously, we're not telling anybody to go out and get married specifically, none of this kind of joking stuff, but it's interesting that, okay, there are further considerations. And I think just like all of this stuff, it's just understanding. Like, I had no idea until you just said that about the HSA, if it doesn't go to a spouse, that this thing is taxable in the year of death, which seems ludicrous to me because as we know it, the HSA is this incredible, essentially triple tax free account. And then it takes on a completely different character if it's not being passed to a spouse, as you're describing it, Sean.
Yeah, Brad, let me just add one additional piece of it. So you say, oh, I didn't know about this thing where if I leave it to my son, daughter, sibling, parent, it's fully taxable to them. Well, there is one workaround that if we're not married, and it's leave it to a charity, right? So the charity, I mean, technically, I guess it would be taxable to them, but they don't pay income tax. So, if you have an HSA, a Roth IRA, a traditional IRA, a taxable brokerage account, and you want to do something for charity at your death, maybe you don't want to do all that much, but you want to do something. Well, the first asset to leave to a charity is the HSA. Traditional IRA would probably be the second one, but certainly the first one, the lowest hanging fruit is, hey, I have a $20,000 HSA. I'll leave that to charity and then leave the rest of it to my children, my siblings, my parents, whoever it is. Okay, great. I mitigated the tax hit that way.
Awesome. All right, Sean, we're coming into a close here. We've got a question from Ted. And Ted said, I actually wanted to add an additional thought to the discussion. You can use money in your IRA to pay for health insurance premiums even before 59 and a half. There are some rules, of course, but I don't think I've heard anyone you've spoken with talk about this so far. And Ted attached an article and he said, thanks, keep up the great work. And Sean, I'm curious, what are your thoughts about this? So using money in an IRA to pay for health insurance premiums.
Yeah, so there are two potential paths that could be available to avoid that pesky 10% early withdrawal penalty when we have medical insurance premiums before 59 and a half. One of them is the medical expenses, right? So medical expenses that are above 7.5% of our modified adjusted gross income, we could take IRA distributions and pay for those medical expenses without the penalty. And it could be health insurance premiums, it could be doctor's visits, it could be any qualified medical expense. So, quick examples. And most early retirees are not going to have $100,000 of modified adjusted gross income, but to make the number simple, let's use that, right? So, say our modified adjusted gross income is $100,000. And then we had 10,000 of medical expenses, including health insurance premiums this year. Up to 2,500, there's this floor. The 7,500, no, we don't get credit for that. But above that floor, we could take 2,500 in my example out penalty free. We'd still pay tax if it's a traditional retirement account. So that's one potential avenue available on that. That 7.5 floor is sort of pesky in this regard, but it's at least out there. The second avenue that's available is not available to all that many in the FI community, but it's at least worth barking up the tree, right? So this rule says that health insurance premiums specifically, all right, can qualify for the exclusion from the 10% early withdrawal penalty, regardless of amounts. We don't have to do any, calculation like I just did. If during the current year or the previous year, we have received 12 or more months of unemployment insurance compensation. So we were essentially fired or laid off or something like that. For the early retiree, I tend to think that won't be applicable, but I guess you never know. And I certainly haven't run through all the permutations and combinations. But yeah, if we've received unemployment insurance this year or last year, and we have medical insurance premiums that we're now paying out of pocket, we might want to think about, okay, maybe that's a valve to qualify for a penalty exception.
Awesome. All right. So, Sean, that I think brings us to a close here in terms of the questions that we're going to talk about on the podcast. We did have two other ones come in that actually you wrote up a really significant article that we will link to in the show notes for sure. And I think it gives a flavor on both of these questions. So just to kind of whet people's appetites, and if you want to talk about this even for a couple seconds here, but basically Jessica asked a very broad question about if you have different types of accounts. So she asked, what if you have a decent amount in Roth 401k in addition to Roth IRA? How would you leverage this? And in what order would you pull out the assets? And I think that was the key from Jessica's question. And then Kelsey asked a really cool one, which was, I can't help but wonder if there is a spreadsheet or a simple checklist for the best way to access funds when you retire early. Now, Sean, I know we don't ever like to be specific, and there's no world where we could ever give advice to everyone. It is inconceivable. But I'm getting the sense from the first look that I had at this article that you did try to touch on both of these questions in that article.
Yeah. So what I'll say about that is a couple things. One, I do tend to think the taxable assets first, I think has just a lot of advantages, right? It's not going to be available to everybody out in the audience, but boy, the taxable assets first has so many advantages from tax planning perspective, keeping our taxable income low, creditor protections better when we take out our taxable assets first. The other thing I want to touch on, and I touch on it in the blog post, is for many folks, it may be a combination of one or more of these methods. So what I mean by that is I'll give you two examples, or I'll give you one example, two flavors, right? Maybe someone retires and they're using the rule of 55. Great, but that does create taxable income. And maybe it's December and they just need a few thousand more bucks to live for the rest of the year. So they're going to take out their last distribution. They see, oh, that last distribution is going to kick us into the 22% bracket. Well, that guy Sean was talking about Roth basis. Someone wrote into Choose FI and talked about HSA PUQME, right? Maybe what I do for that last distribution is I've been living on rule of 55. That's fine. But just to make sure for this year, we don't, go into that 22% bracket, just that last distribution, I'm going to take old contributions from my old Roth IRA. Or, oh, there's that funny term PUQME out there. I'm going to take a withdrawal of some old PUQME. And so either one of those two will make that last distribution tax-free, meaning I will be in the 12% bracket for this year. So that could be one way where we sort of have a primary method. In that case, it was rule of 55. And then we have a secondary complementary method, Roth basis recovery or HSA PUQME recovery, where we're just managing for tax rate. We're just playing the game a little more sophisticated than maybe some other people do.
Very, very helpful. And like I said, we will have that article linked up in the show notes. And Sean, as always, thank you for being here. Thanks for all your expertise. So, fitaxguy.com. Is there another way for people to reach out to you?
Absolutely, Brad. You could reach me at my financial planning firm, MullaneyFinancial.com. And I am on YouTube at Sean Mullaney Videos and X at Sean Money and Tax.
Beautiful. Sean, as always, thank you. And until next time, I'm sure we're going to have another mailbag episode coming up real soon. So if you're listening to this and you have questions on this or any other topic, just send them in to us, feedback@choosify.com, or really the easiest way is to get on my newsletter at choosify.com/subscribe and just hit reply to any single one of those emails. And until next time, thanks for listening to Choose If I.